Imagine it's 1976. You're a currency trader in London, watching the pound lose a quarter of its value in 18 months. Your government is on the phone with the IMF, begging for the largest loan the fund has ever issued. The nation that once printed the currency of a quarter of the earth is now being told, by outsiders, how to run its own economy. This isn't a story about Britain, it's a preview. 5 currencies believed they could stand where the dollar stands now. All 5 failed. And the reason was never bad luck. It was always the same constraint. What people think is happening. The popular story is simple. A country grows powerful. Its economy gets large. Naturally, the argument goes, the world starts using its money. GDP becomes currency dominance almost automatically. What is actually happening? That is not how it works, and the historical record is almost cruelly consistent on this point. Becoming the world's reserve currency requires a country to accept things most governments are unwilling to accept. Permanently open capital markets, enforceable rule of law for foreign creditors, and, this is the part nobody likes to say out loud, a willingness to run persistent trade deficits so the rest of the world can actually hold your currency. Economists call this the Triffin dilemma. To supply the world with dollars, the United States has to send more dollars out than it takes in. That's not a flaw in the system. That is the system. 5 currencies tried to take that seat. Let's start with the one that used to sit in it. Case 1. The British pound. The pound sterling was the world's reserve currency before the dollar. For most of the 19th century and into the 20th, sterling did what the dollar does now. Priced global trade, backed foreign reserves, anchored a financial empire that stretched from Cairo to Calcutta. 2 world wars ended that. Britain financed both by borrowing, mostly from the United States. By 1945, Britain owed enormous sums abroad. What economists at the time called the sterling balances, debts to former colonies and wartime allies that Britain could not simply cancel. In 1944, at Bretton Woods, the pound was formally demoted. The dollar, not sterling, became the anchor of the new global system, because the dollar was the only major currency still backed by gold reserves that hadn't been drained by war. Britain tried to hold on anyway. In 1947, under American pressure, sterling was made briefly convertible to dollars. Foreign holders sold it so fast the experiment was abandoned in 6 weeks. In 1949, the pound was devalued by 30%. In 1956, during the Suez Crisis, the United States threatened to sell its holdings of British government debt unless Britain withdrew from Egypt. And Britain withdrew. That is worth sitting with. A currency crisis ended a war. In 1967, the pound was devalued again, this time by 14.3%. And in 1976, with inflation above 20% and the currency collapsing, Britain went to the IMF for a loan of $3.9 billion, the largest the fund had ever issued, and accepted the conditions that came with it. Spending cuts, monetary discipline, oversight from outside the country. Here is the hidden mechanism. Reserve currency status is not a reward for the past. It is a bet on the future. The world held sterling because it assumed the British Empire's productive capacity would keep backing it indefinitely. When the empire dissolved and the debts remained, the bet stopped paying off. The pound didn't fall because Britain made one mistake. It fell because a currency built on imperial scale cannot survive the empire's end while still carrying the empire's debts. Who benefited? The United States, whose dollar absorbed the reserve role sterling vacated. Who paid? British workers and pensioners, through the austerity, unemployment, and currency devaluations of the 1970s. The constraint was irreversible the moment the war debts were signed. There was no version of history where Britain kept a global empire's currency without an empire to fund it. Let that sink in. The first challenger didn't lose to the dollar in a contest. It lost because it was already spent before the race began. Case 2. The Soviet ruble. Picture Moscow, late 1990. Officially, 1 ruble was worth roughly 60 cents. Unofficially on the street, that same ruble traded for a few American pennies. 2 prices for the same piece of paper existing at the same time in the same city. That gap is the entire story. The Soviet Union was, by some measures, the world's second largest economy for decades. It had nuclear weapons, a space program, and a currency it could have tried to internationalize. It never seriously could, and the reason is structural, not political. A currency's value comes from what you can reliably exchange it for. The ruble's price was not set by markets. It was set by the state, arbitrarily, disconnected from what the ruble could actually buy. Soviet citizens couldn't freely convert rubles into dollars or into most goods because those goods were rationed, subsidized, or simply unavailable. The Soviet bloc even built a separate accounting currency for trade among satellite states, the transferable ruble, precisely because the domestic ruble wasn't credible enough to use even between allied communist economies. This isn't accidental, it's structural. A currency issued by a command economy carries no external discipline. There's no market forcing the state to justify the exchange rate with actual output. For decades, that didn't matter because the ruble never had to compete internationally. The Soviet economy was largely sealed off from world trade. But sealing off a currency from scrutiny doesn't make it strong. It just delays the moment the world finds out what it's actually worth. That moment came in 1991. As the Soviet Union collapsed, so did the fiction holding up the ruble's value. Price controls were lifted in Russia in January 1992. Inflation that year exceeded 2,500%. Citizens who had spent a lifetime saving rubles watched those savings become worth a fraction of what they had been in months, not years. Who benefited from the old system? A narrow class of party officials and black market currency traders who understood the real, unofficial exchange rate and positioned themselves around it. Who paid? Everyone else. An entire population whose life savings were denominated in a currency that had never actually been tested by a market and failed catastrophically the first time it was. The constraint here wasn't debt, like Britain, it was trust. A reserve currency requires the rest of the world to believe your central bank will behave predictably inside a system where prices tell the truth. A command economy cannot produce that belief because its entire premise is that prices should not be left to tell the truth. The ruble was never a real contender. It only looked like one from far enough away. Case 3. The Japanese yen. Tokyo, 1989. Land under the Imperial Palace grounds is, by some estimates that year, worth more on paper than the entire state of California. Japanese banks are the largest in the world by assets. The Nikkei stock index is about to hit an all-time high of nearly 39,000 points. Japanese officials are openly discussing yen internationalization, a real, funded, deliberate campaign to make the yen a genuine reserve alternative to the dollar. 4 years earlier, in September 1985, the world's major economies had signed the Plaza Accord, a coordinated agreement to weaken the dollar and strengthen the yen, partly to address America's trade deficit with Japan. It worked. The yen appreciated from roughly 240 to the dollar down to around 120 in just 2 years, a near doubling of its value. Here is where most retellings stop, with the yen rising. The hidden mechanism is what happened next. A stronger yen hurt Japanese exporters, so the Bank of Japan cut interest rates aggressively to cushion the blow. Cheap credit flooded into Japanese real estate and equities instead of into the productive economy. Asset prices detached from anything resembling underlying value. When the Bank of Japan finally tightened policy in 1989 and 1990 to cool the bubble, it popped, hard and all at once. What followed is now called Japan's lost decade, though in hindsight it stretched closer to 2. Land prices fell for years. Banks, loaded with loans backed by that land, became insolvent in slow motion. The Nikkei would not reclaim its 1989 peak for over 3 decades. Deflation, not inflation, became the central bank's enemy, an economy so wounded that people stopped spending because they expected prices to keep falling. Who benefited from the yen's rise, at least temporarily? American exporters who got a cheaper dollar to sell into, and Japanese asset holders, on paper, before the crash, erased those gains. Who paid the price? An entire generation of Japanese workers and savers whose wages stagnated for 20 years while the country's banking system quietly worked through decades of bad debt. The constraint here is a trap most challengers don't see coming. Internationalizing a currency means opening it to foreign capital flows, but foreign capital flows are fast, and domestic asset markets are slow to adjust. Japan tried to become a reserve currency issuer while simultaneously running an export-dependent growth model that required a weak currency to function. Those two goals cannot coexist. The yen never rose above roughly 6% of global reserves, and it hasn't meaningfully grown since. Japan chose export dependency over currency dominance, whether it meant to or not, and the lost decade was the bill for the attempt. Case 4. The euro, January 1999. 11 European nations retire their national currencies and adopt a single one. It's the boldest monetary experiment of the century. An economy roughly the size of the United States, with a shared central bank issuing a currency with genuine ambition to rival the dollar. By 2009, the euro reaches roughly a quarter of global reserve holdings. For a moment, the story writes itself. Europe has built a real second pillar for the world's money. Then Greece happens. In late 2009, Greece's government revealed its budget deficit was far larger than reported, eventually over 12% of GDP, more than 4 times the eurozone's supposed limit. Bond markets, which had been pricing Greek debt almost identically to German debt for a decade, suddenly woke up to the fact that Greece and Germany were not, in fact, the same credit risk. Yields spiked. Portugal, Ireland, Italy, and Spain came under the same scrutiny in turn. By 2012, Greek unemployment exceeded 24%. Youth. Unemployment in Spain crossed 50%. The European Central Bank, the IMF, and European governments assembled bailout after bailout, each one carrying conditions that stripped elected governments of budget authority. Here is the mechanism nobody wanted to name out loud in 1999. A currency union is not the same as a fiscal union. Every country in the eurozone shares one interest rate, set by the European Central Bank in Frankfurt. But Germany's economy and Greece's economy do not move together. When one interest rate is too tight for one country and too loose for another, the mismatch doesn't disappear. It accumulates silently until a shock forces it into the open. There is a historical precedent for exactly this failure mode: the interwar gold standard. Countries pegged to gold in the 1920s and 1930s lost the ability to adjust their currency to their own economic conditions, and that rigidity turned an ordinary recession into the Great Depression. The euro recreated the same rigidity, a fixed monetary system without an internal adjustment valve, inside a single continent. Who benefited from the euro's structure? German exporters, whose currency, shared with weaker economies, traded at a permanently undervalued rate compared to what a standalone Deutsche Mark would have commanded. That undervaluation subsidized decades of German trade surpluses. Who paid? The periphery: Greek pensioners whose payments were cut, Spanish and Portuguese workers who left for jobs abroad, an entire cohort of young Southern Europeans who came of age during years of enforced austerity they did not vote for and could not reverse through this ballot box because the real decisions were being made in Frankfurt and Brussels. The euro never collapsed. It's still here, still the second largest reserve currency, holding around a fifth of global reserves. But it stopped growing. It plateaued exactly where the underlying flaw predicted it would. A currency strong enough to survive, not strong enough to challenge, because it was built without the one thing that makes the dollar's system work: a single treasury standing fully behind it. 19 finance ministries do not add up to one. Case 5, the Chinese renminbi Beijing, October 2016. The International Monetary Fund formally adds the renminbi to the basket of currencies, backing its special drawing rights, an elite club that until then held only the dollar, euro, yen, and pound. State media calls it a milestone. It is presented as the moment China's currency finally takes its place among the world's reserve elite. Almost a decade later, the renminbi holds under 2% of global foreign exchange reserves. China's economy, by most measures the second largest on earth, has a currency that ranks well behind the Japanese yen, and not far ahead of the Canadian dollar in reserve status. That gap between economic size and monetary weight is the entire story of this case. What's actually happening is a choice China has made, repeatedly, and stood by. China maintains capital controls, limits on how freely money can move in and out of the country. The exchange rate is managed, not freely floated, guided daily by the People's Bank of China, rather than set purely by markets. Foreign investors face restrictions on how much they can move into and out of Chinese bonds and equities, and the legal system that would enforce foreign creditors' rights in a dispute operates under rules foreign holders can't fully predict. This isn't accidental, and it isn't incompetence. It's a deliberate application of what economists call the impossible trinity. A country can have at most two of the following three things at once: a fixed or managed exchange rate, independent control over its own monetary policy, and a fully open capital account. China has chosen the first two. It will not give up the third, because an open capital account would mean Chinese savers could move their money out of the country freely, and Beijing is not willing to risk the capital flight and the loss of monetary control that would follow. There's a precedent worth naming here, and it isn't a flattering one for Beijing. It rhymes with the Soviet ruble, not in ideology, but in mechanism. A currency that the state controls too tightly cannot earn the trust that a reserve currency requires, because the rest of the world can never be sure the rules won't change overnight, by decree, without market warning. Who benefits from China's approach? The Chinese state, which retains tight control over its financial system and avoids the kind of capital flight crises that have hit more open emerging economies. Who pays? Everyone hoping to use the renminbi internationally. Exporters and Belt and Road partner nations who take on renminbi-denominated financing and discover the currency isn't as liquid or as freely convertible as they assumed. And foreign investors who demand a trust premium for holding an asset they can't be certain they'll be able to move freely when they need to. At this point, China faces the same choice every prior challenger faced, dressed in new language: open the capital account and risk the instability an open system invites, or keep control and accept that the renminbi will remain a regional trade currency, not a global reserve one. None of the options are painless. That's the trap. So far, Beijing has chosen control every time it's been tested. Look at what's actually common across all five. Britain had the deficits and the deep capital markets, but not the productive economy left to back the debts. The Soviet Union had the scale, but no market pricing anyone could trust. Japan had the trade surplus and the capital, but chose an export model incompatible with currency dominance. Europe had the economic size, but never built the fiscal union a currency of that size requires. China has the economic size and growing capital markets, but won't relinquish the control that reserve status demands it give up. 5 different failures. One constraint, wearing 5 different masks. Becoming the world's reserve currency requires giving something up permanently. An empire, a closed economic model, and export dependency, national fiscal sovereignty, or state control of capital. Every single challenger reached the point where the price of continuing became visible, and every single one, when faced with that price, chose to stop. This is where it breaks. Not from an external attack, from an internal refusal to pay the actual cost of the role. The dollar has paid that cost, whether Americans always notice it or not. Persistent trade deficits that hollow out parts of domestic manufacturing. Total dependence on foreign confidence in a legal system, a central bank, and a treasury market currently worth close to $30 trillion in outstanding debt. The deepest, most liquid pool of safe assets on the planet. The exact asset every one of these 5 currencies needed and never managed to build at comparable scale. Think about what that means. The dollar's dominance was never really a prize the United States won. It was a bill the United States has been paying continuously since 1944 that no other country has yet been willing to pick up in full. This is historical and educational analysis, not financial or investment advice. The question now isn't whether another currency can challenge the dollar. History shows several genuinely tried, with real resources and real intent behind them. The question is whether any government, anywhere, is willing to pay the specific price each of these 5 discovered too late they weren't prepared to pay. History doesn't repeat, but it rhymes. The pattern is already in motion somewhere in a currency you may not even be watching yet. This channel exists to study the autopsies before they repeat.